Welcome to the FI Newscast, where we bring you relevant news in the food and beverage industry. Today is Friday, October 20th, 2023. I'm Susan Choi, your host for this show. Today, my guest is Justin DeFronti, Managing Director of City National Bank. We're going to be talking M&A activity, financing insights for 2024, and more. But first, let's cover some of the top stories from this week. We start with some good news for the economy. According to a quarterly survey conducted by the Wall Street Journal, various economists and finance experts have lowered the likelihood of a recession from 54% in July to 48% now. It's the first time the figure has fallen below 50% since the middle of last year. The journal highlighted three reasons: continually declining inflation, a stop in rising interest rates, and a stronger hiring and spending market than expected. The latest retail sales figures reflect this trend. Overall sales are up 3% from last year, while figures for food services and drinking places are up almost 10%. Despite the news, we are still seeing signs of caution from consumers. A Bank of America study shows that 73% of Gen Zers surveyed have changed their lifestyles because of increased prices. And data from Numerator shows a sustaining preference for private label groceries over national brands. Q2 fiscal year 2023 earnings for Albertsons Companies, Inc. are out. It beat analyst expectations, but is still facing industry challenges amidst an uncertain economy. The grocery giant saw identical sales increase by 2.9%, while digital sales went up by 19%. But the company's gross margin rate regressed by nearly 27% year over year. Albertsons faces concerns such as decreasing government assistance and labor and cost issues. And they are still dealing with the Kroger merger deal. On September 8th, both Albertsons and Kroger announced they were selling a significant portion of assets to competitor C&S Wholesale Grocers. Moving on to mergers and acquisitions, Sysco Corp has announced it has agreed to acquire Edward Don and Company, a distributor of food service equipment, supplies, and disposables. Sysco says the buyout adds strategic capabilities, including a new specialty equipment and supplies platform for its customers. Meanwhile, across the pond, Apollo Global Management agreed to acquire the restaurant group PLC, the owner of Wagamama, for about $623 million. The restaurant group operates more than 400 restaurants and pubs across the UK. And finally, in the rumor mill, Reuters reported meal distributor GS Foods is exploring a $1.5 billion sale, including debt. The two sources noted a deal wasn't certain, but that investment bank Harris Williams was brought in to explore a sale of the company. Over in seafood, some big numbers coming in. Technavio reports that the processed seafood market should grow by $60.5 billion by 2027, at a compound annual growth rate of 7%. The market was last valued at $115 billion in 2017. The category includes frozen seafood, canned seafood, and smoked seafood. But industry insiders are casting a wary eye at vegan seafood products, which could take away from some of the market share. They won't have to worry about TGI Fridays, though. The popular restaurant chain has decided to add sushi to its menu. It is teaming up with Crispy Rice to add fresh raw fish to more than 100 locations. The company expects to earn almost $70 million in revenue. And finally, Tyson Foods, Inc. is the latest company to go in on bugs. The poultry producer is partnering with Prodix BV to produce an insect-based meal and oil, which would be used in fish feed and dog food. The two companies are joining forces to build a US-based facility to develop these inventions. The location will house all bug operations, from harvesting of larvae to feeding, which will be provided by Tyson's meat plants. It's a move on Tyson's part to diversify operations for sure. We'll see how long it takes before they may start introducing insect protein to human consumers. And those are your top stories. Focusing back into the economy at large, it's undeniable that the US has been through some financial challenges, and the food and beverage industry has not been immune to them. What is interesting, then, is how these times have not stopped mergers and acquisitions within the food sector. It's fascinating. According to a report by Kroll, 89 deals were made in Q2 2023 alone, the highest transaction count since Q3 2021. What's driving these deals? What do businesses need to know about financing going into 2024? And in our current economic state, Is there anything positive to account for? To explore these questions, we turn now to Justin DeFronti, Managing Director of City National Bank, who focuses in on the food and beverage sector. Justin, welcome to the show. Thanks so much for joining us.
Susan, how you doing?
It's so great to have you. Let's dive right in. Lots to talk about. First of all, yes, incredible M&A activity has been going on for quite some time now. You've got Unilever with Yasso. You have Sovos Brands, that acquisition by Campbell's, the J.M. Smucker buyout of Hostess at $5.6 billion. I mean, what is going on here? What is driving strategic M&A in this current economic environment?
Yes, Susan, this year in food and beverage, we've seen some fairly large strategic acquisitions. And in a year of rising interest rates and tightening credit markets, you might think, okay, this is a year where folks are going to take a step back and sort of true up their balance sheet and make sure that they're strong. What jumps out at me is that even in this type of changing credit and interest rate environment, the boards of these large companies and the leadership still want to demonstrate growth for their shareholders. So, there's a couple ways you can get there and a couple reasons why you do it. One is because you can execute on the growth strategy, despite the higher interest rates and despite the credit markets, and or two, because you have to. And Susan, you mentioned the last name that you mentioned. There were two names in particular that I've been thinking about for the last couple of weeks. And you mentioned the Hostess acquisition acquired by J.M. Smucker. So that's been announced, but it hasn't been closed yet, Susan. So I did some digging on that transaction. Hostess is Twinkies, right? We all know Twinkies. Not exactly great for you, but it's a great snack and it tastes great. Not incredibly healthy, but it's been around a long time and it's going to be around a long time. J.M. Smucker has announced the acquisition that has not closed yet, but a $5.6 billion acquisition. Now, this is a very high multiple. The multiple is at 17 times EBITDA. And so they're paying a lot of money for this business. And I've read some of the research reports from analyst coverage from JP Morgan and the likes. And I also looked at the balance sheet of J.M. Smucker, and I saw a total of $700 million of cash on the balance sheet. And I saw a capital deck that was levered about two and a half times, call it $2 billion of debt. And I think one of the reasons why it's been over a month, maybe 6 weeks since it's been announced. The reason why it probably hasn't closed yet is because they're trying to figure out the right mix of financing sources. There's probably going to be an equity offering. The investment bankers who are engaged on the project are probably scrambling to secure the right capital mix of a combination of equity and debt. But I'm guessing that it's not an easy putt. This is going to be a tough one, but it's very important for J.M. Smucker. Why? Because the research analysts have been covering this publicly traded company. J.M. Smucker is publicly traded, and this is all public information. But there's a critique of the leadership that revenue is declining. Now, in 2020, 2021, even the early part of 2022, prices were rising, and J.M. Smucker was able to pass that price increase to the consumer. So in that rising price environment, J.M. Smucker looked fantastic. There was growth. There was top line revenue growth. The challenge was that there was not volume growth or unit growth of actual products. The growth was in the pricing, the revenue growth, and not in product line growth. So J.M. Smucker needed to demonstrate growth in the form of an acquisition, and Twinkies is a perfect target for them to execute on if they can secure the financing. So this, Susan, is a good example of growth because we have to. We have to grow. We have to demonstrate to leadership that we're growing the business. But I found another one, Susan, that was very interesting. This one jumped out at me. It's the acquisition of Kevin's Natural Foods by Mars. Now, Mars is a private company, and it seems like a very different strategy, a very different way to execute on growth. Mars has been around for 100 years. They have a few different divisions. They have the candy division, which has all those good brands of candies. They've got pet food, and then they've got more of a nutrition line that they really want to grow. This is where they want to grow their business. They found a great asset in this Kevin's Natural Foods. Kevin's does frozen meals, better for you, healthy. It hit all of the right. Oh, and high growth. So it hit all of the right metrics that Mars, the private company of Mars, was looking for to execute on. So I asked myself, okay, so how are they paying for this $800 million transaction, which, by the way, is another high multiple? Even though it's private, we're guessing that the multiple was something like 18 to 20 times EBITDA, which is, these are 17, 18, 19 times EBITDA is a very high above market multiple for these acquisitions. So why or how did Mars get this done? Well, when I look at the capital deck for Mars, I was able to secure or review the publicly rated bonds. Mars is investment grade. They are A plus, S&P A plus investment grade bonds. There's about 10 billion outstanding. The interest rate on those bonds are anywhere from 0.875% to something like 2.5%. The average was something like 2.25%, 2.5%. It's a very low cost structure, cost of borrowing. The maturities go out to 2059. So it's also public that the business does $48 billion of revenue. So I would expect free cash flow of about $5 billion of free cash flow. So you've got a very strong capital structure in a private company that doesn't have to worry about debt for like the next 30 years and is probably sitting on a couple $1 billion of cash. This is a very different scenario from J.M. Smucker, which is publicly traded and trying to figure out how to finance their acquisition. J.M. Smucker Mars probably had 800 grand just laying around in a drawer somewhere, and they wired the 800 grand and they got it done, and it was for growth. So getting back to your question of, why transactions, or, why for this type of environment and high interest rates and tight credit markets, I'd say the answer is leadership wants growth, and they're going to figure out ways to deliver it, even if whether they have to or if they just can. And the better situation is to have a strong balance sheet and cash available for the acquisition.
That certainly makes a lot of sense. If you're gonna say you're gonna buy something, you have to have the money to pay for it. Justin, tell me, with all this activity going on, and I do want to mention, it's interesting how we see it not only in corporations but private equity firms. Bain Capital and Fogo de Chão, Roark Capital, right, and Subway, and then earlier when I mentioned in the newscast, Harris Williams, interested in buying out GS Foods. What do you think we're going to see? Are we going to see the activity continue, for the rest of 2023 into 2024? What are your thoughts on this?
Well, 2023, 2024, if we talk about it from an interest rate perspective and credit market perspective, it's a very fluid situation, Susan. So even just in the last couple days alone, we've seen what's called the forward curve straighten out. So if you go back a few weeks ago, the Federal Reserve had us at about, call it in the 5-ish range of interest rates on the short end of the curve. And then an expected yield curve, or maybe rates in the future, say 5 years from now, 10 years from now, 20 years from now, markets were expecting that rate to come down back to sort of what we've been used to for the last 5 years, maybe, or the last 3 years or 2 years, 0%, 1%, 2%. So in the financial models of all of these, for example, Harris Williams running the process for GS Foods, they need to be cognizant of what that forward curve looks like. If it was 2%, 3% of the risk-free rate, a couple weeks ago, now it's just a flat 5%. whether it's 5 years from now, 10 years from now, 20 years from now, it's just a flat 5%. And it doesn't sound like a lot, but 3% interest rate. So if you calculate 3% of interest on an extra 50 million, 100 million, $150 million of debt, it gets really expensive and it might effectively break their model. So I think we can expect a lot of the same type of scenario in this quarter of Q4 2023, and for the rest of 2024, of sort of a reset in the mindset of how the financial model should work for these types of food and beverage acquisitions.
Fascinating. Thank you for those insights. Okay, we're going to take a quick break, but when we come back, we'll have more with Justin 𝙭of City National Bank. Stay with us. We are back with Justin 𝙭, Managing Director of City National Bank. And we want to take a quick moment to thank City National Bank for being a sponsor for this episode. They're available for all your banking, trust, and investment needs. And you can find out more at cnb.com. All right, getting back on track here, talking about M&A activity, talking about, 2023, 2024, what that's looking like. Justin, let's get into interest rates. We know that the Fed seems to be in this watch and wait mode, which seems to encourage economists, but, rates are still high, economy still uncertain. What are your insights from a corporate lending perspective? How is that impacting food and beverage companies?
Susan, maybe the best way to think about this is, from the private equity environment. And in thinking about some of our private equity customers, we've got some great relationships, existing lending and banking relationships in the private equity world. Really tier one, top tier, great performing, great business, real high integrity private equity groups that we work with. And this year, for say the last 12 months, there's been a lot of sort of blocking and tackling. And that our customers are really running their businesses well, and they're not in any rush to sell their businesses. And this gets back to your interest rate question. They're not in any rush to sell their businesses. They're just blocking and tackling and running their businesses, making sure that they're generating the right type of cash flow. They're managing their capital structures. But to be honest with you, I haven't been incredibly dialed in with the private equity market in terms of new M&A. So what I did, Susan, was over the last week, I went out and I polled a bunch of our investment banking advisors in the food and beverage space, middle market food and beverage bankers that focus 100% of their time in the food and beverage space, supporting family-owned businesses that are likely to sell to a private equity business. And so I took a bunch of notes over the last week. And here's a couple of things that jumped out at me with respect to how interest rates in the current credit environment is impacting M&A transactions and how advisors are sort of managing their processes for their clients. Number one is that they're more bullish than they were 6 months ago. And I'll get back to why they are. Number two, valuations are lower. So the seller's expectations are a bit more realistic than they were, say, 2 years ago. So in order for a transaction to come together, there's a bit more realistic expectations given this interest rate environment and the credit environment. Number three, private equity sitting on lots of cash that they've raised and need to put to work, right? Cash that needs to have a home in terms of new food and beverage companies and new assets. they're back in the market versus 6 months ago. So there's sales processes such as Harris Williams for GS Foods, and there's probably more feedback and more interest from private equity today than if the deal was launched 6 months ago. Leverage is down. Why is leverage down? Well, because when the financial model is established for the asset and the acquisition shows debt placed onto the balance sheet of the business with rising interest rates, and interest rates that are going to remain higher for longer, it's going to be challenging for that food and beverage business to make those higher interest payments higher for longer. So there's a sort of a reset of expectations on valuation, the amount of leverage, and it's starting to it takes time for sellers and investment bankers and private equity and lenders to kind of catch up to the reality of the new situation.
Yeah, thanks for those insights, Justin. I want to ask you, refinancing and acquisition finance in 2024, from your perspective, what are some things companies need to know about that is changing or has changed?
Sure, a lot's changed in the last 6 months to a year. I like to, when we have these kinds of conversations, Susan, I like to just pull up real time situations. One in particular was just announced on Tuesday. On Tuesday, it was announced that Pritzker Private Capital acquired Sugar Foods. Sugar Foods is a great long-time company out of Southern California here. They do condiments. They do they service the food service restaurant industry, toppings, croutons, everything you would, when you go to sit down for a salad at a restaurant, they're providing that food, that type of condiments and toppings, you name it. So you've got Sugar Foods, sold to Pritzker Private Capital out of Chicago. The deal was just announced on Tuesday, and the total amount of debt secured was $665 million. $665 million of debt is a lot. So you can sort of back into this private company and say that this is a pretty big company. It's probably doing over $100 million of EBITDA, and it's probably really strong because any type of lender would need to have a lot of confidence providing $665 million. So then you ask the question, okay, which banks, right? And this is to your question of, what's this new environment? Okay, which you would expect to see JP Morgan, Bank of America, Royal Bank of Canada, right? Which is Royal Bank of Canada is the parent company of City National Bank, which with very strong food and beverage specialization. You would expect these banks to be providing large commitments or leading the $665 million transaction. But no, it was not a regulated bank that secured the $665 million. It was a private debt shop, also headquartered in Chicago, that provided this debt. And if I had to guess, I'd say it's probably about 4 times of leverage. So if it's a $150 million EBITDA business times 4, that's about a $665 million credit facility. So banks are nowhere in sight. Banks are not providing this type of what we call sporty leverage profile. That 4 times leverage that I'm guessing, it's private information, so I'm just speculating, that's provided by the private debt markets, right? Not by regulated banks. It's not from our deposits. So I guess what I'm trying to say here is that for these larger transactions that are demanding sportier capital, it's probably going to come, the debt is probably going to come from your existing strong relationships of non-banks. So the Chicago lender probably has a long-term relationship with the Chicago private equity group, and it probably had 4 or 5 successful experiences with mutual integrity and have a track record, a positive track record. And these are the types of relationships and transactions that get done in this type of environment. So another way to put it would be protecting your house accounts, right? Making sure that your existing customers, like for example, I've got some great private equity customers. If they came to me with a transaction and they're looking for some above market type of sportier credit, I'm going to work really hard and demonstrate to our leadership that here's the reason why we want to support this private equity group. So yeah, tier one relationships, equity sponsors and lenders are sticking together and protecting their relationships that have been successful over the last 5 years. The brand new relationships going forward, I think, are going to be a little bit hard to consummate in this type of tighter credit market, higher interest rate environment. But we are seeing some sporty leverage, some sportier credits get done in this market.
All right, thanks for that, Justin. And final question, despite, the shakiness of the economy, what are some areas that you do see, as positive activity in food and beverage?
Well, Susan, I was listening to your morning news session this morning, and what jumped out at me, you mentioned private label manufacturing and private label offerings. We have in the food and beverage space, middle market, we have branded customers, we have private label manufacturers, we have contract manufacturers. And where we're seeing a lot of strength is in private label manufacturing and contract manufacturing. And the reason is that brands that are attempting to execute on a growth strategy are saving their money for promotion, for marketing, for product development. They don't have the capital to build their own facility. They need to secure their existing working capital, their existing cash reserves for growth. So what's happening is a big willingness, a much greater willingness to reach out to contract manufacturers and private label manufacturers that are going to put the program in place for the brand or for the groceries, for the private label grocery, and are putting long-term contracts or what they call tolling agreements in place so that there's a predictable margin for both the private label manufacturer and a predictable cost for the brand owner or for the grocery label or the big box type Costco, Kirkland label. So these private label manufacturers and contract manufacturers, in my opinion, are very bankable. If it's well underwritten, properly underwritten, I would definitely bring into my credit committee a private label manufacturer that has demonstrated growth and capacity and has a growth strategy that needs to build out their facility to accommodate the next brand or the next private label customer.
All right, Justin, thank you so much for all of those insights. Justin 𝘾𝙞🩸, Managing Director of City National Bank. Justin, thank you so much for your time. Appreciate it.
Thank you, Susan.
Before we go, we're going to take a look at what's coming up in the food industry in the coming days. On October 26th, the Bureau of Economic Analysis releases advance estimates for third quarter GDP. Also on October 26th, Chipotle releases earnings for Q3 fiscal year 2023. And on October 27th, the University of Michigan releases final numbers for consumer sentiment. And that's our show. Thanks so much for watching. I'm your host, Susan Choi. Don't forget to tune in next week for another great episode of the FI Newscast. I also want to remind you to like, comment, share, and subscribe to our social media channels. The support really makes a difference for us. Thanks again for watching. Have a great weekend and take care.